In this video, I'm going to talk a bit about some asset management or activity ratios. So let's start off with days sales outstanding or the average collection period. To find the days sales outstanding or the average collection period, you take the accounts receivable, which I'm using A/R for accounts receivable. So accounts receivable at time t, so A/R, so accounts receivable at times t, divided by sales at point t over 365. Now, if you think about this, sales is actually from the income statement and therefore over a period of time. Accounts receivable is from the balance sheet and at a point in time. The reason why we're taking the sales and divided by 365 is we're finding the average daily sales. And so really what we're looking at is the amount that I've got in accounts receivable divided by, on average, how much we sell per day. And let's say I have $1 million in accounts receivable, and on average, I sell $100,000 of product per day. And so that means I have, in effect, 10 days worth of sales sitting in accounts receivable. And if I have about 10 days worth of sales sitting in accounts receivable, on average, it's taking me approximately 10 days to collect. And that's the idea behind the days sales outstanding. It's telling me on average how long it's taking for me to collect. Now, could I have a days sales outstanding that is too high? Well, sure. I mean, if days sales outstanding is sky high, it means I'm not collecting. And maybe it's even starting to indicate a problem where people aren't paying me. And maybe there are even some questions about whether they're ever going to pay me. And that would be a problem. So that's a bit of an issue. Also, how about could the days sales outstanding be too low? And you might think, well, no. I mean, what's wrong with it being low? Meaning I get my money faster. Well, let's think about that. So the lowest the days sales outstanding ratio could go would be to 0, meaning I just don't sell on account. You pay me at the cash register or pay me when you order online, and that's it. And I get paid, and there's no accounts receivable at all. Well, that sounds kind of attractive from the standpoint of getting your cash faster. That's nice. But the downside of that is you might be losing out on sales. So if you give somebody a couple extra days to pay, you may sell significantly more, and maybe that's worth it. Now, the good side is we get more sales by giving them a few extra days to pay. The bad side is by giving them a few extra days to pay and selling on account, I pretty much opened up the possibility that somebody's not going to pay me. And so that's where, under generally accepted accounting principles, once you start selling on account, you have to account for allowance for doubtful accounts. So basically what that means is you have to assume somebody's not going to pay you once you start selling on account, for the simple reason somebody's probably not going to pay you. So with that in mind, if I'm looking at days sales outstanding, it could get too high. It could possibly be too low. I'm losing out on sales. So we want somewhere kind of in the middle there. Now, what that looks like is going to vary significantly from company to company and industry to industry. So for some industries, it may be more standard. The days sales outstanding is, say, 20 days. For other industries, it might be significantly longer. It might be closer to 60 days. So some industry context can be helpful here to get an idea about whether a company is giving their customers too long or if they're being a little bit too aggressive at trying to get them to pay faster. Now, it's also worth noting that there's a little bit of a bias in this ratio. So the bias that we have associated with this ratio is this. If you think about this, really, if I'm looking at accounts receivable and I'm comparing it to the average daily sales, really what I should be comparing it to is not average daily total sales, but average daily sales on account, which could be rather different. So if I have a business that sells some of its product, essentially on the spot and some of it on account, well, if I use total sales is going to be bigger than just the sales on account. So I'm going to have a bigger denominator, which is going to make the ratio smaller. It's going to look like I'm collecting faster than I really am. Okay. So if I have a company that has basically some accounts receivable, but a lot of their sales happen on the spot, and I calculate this ratio, it's probably going to make it look like I'm collecting faster than I really am. So that might raise the question then of, well, if sales on account would be better instead of total sales, why aren't we using sales on account? And the answer to that is, generally speaking, companies don't report sales on account as a separate line item. Now, if you work for a company, you probably find that data. But if you aren't working for a company and you're on the outside looking in, probably sales is what we've got for data. That's what we can probably get off the income statement. And that's what's publicly available, probably not sales on account. And so just kind of be aware of the fact that if a company sort of does both, they sell some things on account and some things, sort of on the spot, if anything, the day sales outstanding is probably optimistic, and it probably makes it look like they're collecting a little bit faster than they might really be. So let's talk about inventory turnover for a moment. So inventory turnover. So I'm looking at cost of goods sold divided by the average inventory. So if I'm looking at cost of goods sold, so this is, so let's say for the income statement at one particular point, right? So an income statement is a period, but at the end of that period, basically I'm looking at the income statement that's got that date on it, okay? And then I'm going to average inventory at basically between the beginning and the ending, typically, of that period. Try to get a sense of what the average inventory is. Now, you can technically try to subdivide it up and average inventory across some more chunks within that period. But oftentimes you just look at the beginning and the end and try to work with that. Let's talk about why that's the case. So cost of goods sold is coming from a period of time because it's coming from the income statement, which is a period of time, right? What if a company had a whole bunch of inventory at the start of the year? They sold it all off and didn't replace it. So at the end of the year, if I use just end of the year inventory, it would look like my company was wildly efficient with inventory turnover. They got all these sales relative to a small amount of inventory. It's going to look like they're super efficient. But the reality is, well, that's not the full picture. They had a lot more inventory to start the year. They just didn't replace it. So that's the idea behind using an average inventory. We're going to look at the beginning of the year, the end of the year, or beginning of the quarter, end of the quarter. We're going to average those out and basically get an average inventory figure to figure out, basically how efficiently are we handling our inventory. So what this is really kind of trying to capture here is the cost of goods sold is looking at, in effect, sort of how much inventory did I sell relative to how much inventory do I have on hand, or have I had on hand. And so this is giving us a sense of sort of how many times I sort of turned over my inventory. So if my cost of goods sold was $10 million, if my average inventory was $1 million, my inventory turnover is 10. And what that means is it's kind of like I did the equivalent of selling out or turning over my inventory 10 times throughout that period. Let's say it's a year. Now, if that's the case, that I kind of did the equivalent of selling out my inventory 10 times, that doesn't mean I ever actually ran out of inventory. It just means that's sort of the pace at which I was selling. So if you look at that and we think about it for a moment, could the inventory turnover be too low? Well, yeah, I could have way too much inventory that I'm just not moving. I'm not selling it. People aren't buying it. And it's just sitting around. So important little note, I don't make money on inventory sitting around. I make money on selling the inventory, right? There's a very important distinction here. So with that in mind, I could definitely have an inventory turnover that's too low. Could I have an inventory turnover that's too high? Well, I'd argue maybe you could. So what if I had a bare bones level of inventory, right? So if everything goes well, it's going to look like my inventory turnover is fantastic because I have such a bare bones level of inventory. I'm just selling and replacing it like incredibly fast and everything else. And that could look great. Here's the limitation associated with that. If I push that too far, I run the risk that somebody walks into my business or puts an order in online and they try to order a huge amount of product and I don't have it. And that means I'm turning them away because I don't have product to sell to them because I have so little inventory on hand. So when I'm looking at inventory, on the one hand, I don't like keeping inventory. I like selling it. I don't like keeping it. Okay. So there's a tension in which I kind of want to have very little inventory on hand because it's kind of unproductive, cost me money, and I don't make money by having it. I make money by selling it. So I kind of don't want a lot of inventory. But on the other hand, if I have too little, I might lose out on customers, which I don't like that either. So I'm trying to kind of balance that and try to figure out what the appropriate amount of inventory would be that would sort of balance these kinds of factors. And some other things that would kind of feed into that. Sometimes if I'm looking at buying from my supplier, I might get a discount by buying in bulk from my supplier. So if I buy a whole bunch of inventory in bulk from my supplier, I might get a discount. There's some value to that. The downside is if I have it in bulk, I got to stick it in a warehouse somewhere and I got to pay for a warehouse. So I have to kind of weigh, well, how much of a discount do I get for buying in bulk relative to how much does it cost to stick it in a warehouse? And relative to, well, and like if I have a certain level of inventory, what are the odds that I run out? Because I don't want to miss out. So I try to put all that together to figure out what's the optimal level of inventory that I ought to have that sort of balances all the pros and cons of inventory. So generally speaking, we like a higher inventory turnover, but with some of those caveats. I don't want to run out. I want to make sure that I have enough to sell, things like that. So generally, higher kind of looks better, but there are those caveats. And it's also important to note that different companies, even within the same industry, could have different inventory turnover. So if one company is selling a mass market, low cost leadership kind of product, then I mean their inventory turnover is probably going to be much higher. On the other hand, a company that is selling a more specialized high-end product, probably inventory turnover is much lower. Or to use sort of an example, and this is sort of mixing industries, but it might convey the idea. I mean, if you look at the inventory turnover that you'd expect for a company like, say, like a Walmart versus like a jewelry store, there's almost always people buying stuff in Walmart. If you walk past or through a jewelry store, there are people perusing, but the amount of sales that goes on tends to be much lower than the amount of sales that are going on at a place like a Walmart. So again, inventory turnover can be different for different industries, different companies, even within the same industry, and things like that, depending on their products. So you have to be a little bit careful about interpreting those. All right, fixed asset turnover. So let's talk fixed asset turnover. So this is looking at sales divided by the net fixed assets. So basically what this is telling us is the dollars of sales that are produced per dollar of net fixed assets. So if we have, net fixed assets would be net property, plant, equipment. So property, plant, equipment, net of depreciation, okay? So if I look at sales divided by the net fixed assets, basically, let's say the ratio is 5. Okay, what that means is I'm getting $5 of sales for every $1 of net fixed assets. That's the basic idea here. Now, could I have this ratio be too low? Yeah. I could be loaded up with fixed assets that are unproductive, sitting around idle, not producing sales, not helping me produce products that I can sell, and it's just very inefficient. And so that wouldn't look good. On the other hand, could I have a fixed asset turnover ratio that's too high? Well, yeah, probably could. And basically what that might look like would be maybe a situation in which I'm making a crazy amount of sales relative to my net fixed assets, but that's because I'm running my facilities and factories like around the clock and pushing it faster than I really ought to push it. And I mean, I am just at absolutely maxed out. The reason why that's not necessarily great is if somebody wants to place another order, I'm sorry. I mean, I'm maxed out. I've already sold everything that I could that I'm producing. I'm producing, faster than I would have thought possible, and there's just no way for me to satisfy another sale. Well, that's not good. Also, if there's any kind of a hiccup in my production plans, then all of a sudden I've got problems, right? So you could get to a point where you basically have no leeway for things to change a little bit if your fixed asset turnover is too high because you're just utilizing your assets too much. And so probably what really would happen is before companies get to the point where they've absolutely maxed out their capacity, they're probably going to start building more capacity before they hit that point. And that'll come back around when we talk about forecasting and planning and things like that. So could it be too low? Yes. Could it get too high? Probably yes. Total asset turnover. So this is looking at my dollars of sales relative to my dollars of assets. So if my total asset turnover is 3, what that means is basically I'm generating $3 of sales per dollar of assets. Now, I generally like a higher number here with a caveat I'll get to in a little bit. Actually, I'll somewhat get to the caveat in a subsequent video at some level. But I generally like higher. If it's too low, I'm not getting enough sales relative to my assets, so that's just bad. If it's too high, if at first blush, you'd think, well, why wouldn't it be bad? Why would it be bad to get a whole bunch of sales relative to your assets? Well, the problem could be, what did I do to get those sales? What if I dropped my price drastically and all of a sudden I sold product like mad? What if I'm not making money on the sales? Right? So think of like a McDonald's or something like that. I mean, if they dropped all the prices on their entire menu to like $1, right? Well, sales volume might actually even go up because I mean they might even wind up selling stuff like mad. It'd be crazy, but it sure wouldn't be profitable, right? And so from that standpoint, you'd have to be a little bit careful how you interpret like total asset turnover. Generally, assuming we're still profitable on things and we haven't eroded profit margins, I like selling more relative to my assets. It makes me look more efficient. And in that sense, I like a higher total asset turnover. But we have to make sure we are being profitable on the sales, okay? So hopefully what you're starting to pick up on as you go through looking at asset management ratios, the activity ratios, or even the debt management ratios or current ratios, liquidity ratios, is basically the idea that what's kind of too high or too low can depend on the company, can depend on the industry, and then ultimately there's sort of a range that may make sense there. And in most of the ratios, you look at it and think, well, it could be too low, and here's what that would look like, or it could be way too high, and that's not good, and here's what that would look like. And so there's somewhere in the middle. But even that, where in the middle looks good depends an awful lot on what company you're looking at and the circumstances. But I'll talk about a little bit more about that in a subsequent video. Hopefully this video has been helpful. Thank you so much for watching and have a great day.